Welcome to FXTech's weekly GBP/USD analysis. Today, we're examining the British pound versus the US dollar for the week of October 13th through 18th, 2025. This has been a particularly volatile period, with the pair navigating conflicting fundamental drivers, including a weakening UK labor market, a dovish Federal Reserve, an ongoing US government shutdown, and renewed US-China trade tensions. Despite these challenges, GBP/USD has shown resilience, recovering from early week lows to post a modest weekly gain. Let's dive into the details and explore what traders need to know about the current market environment and the key levels to watch in the coming weeks. British pound to US dollar closed the week at 1.34239, posting a 5-day gain of 0.57%. The pair experienced significant volatility, testing a low of 1.3249 before bouncing to a high of 1.34714. Technical indicators from TradingView show neutral sentiment across both oscillators and moving averages, reflecting the market's indecision. Despite the recent pullback, the year-to-date performance remains strong at plus 7.29%. The one-month performance shows a decline of 1.46%, while the 6-month performance is positive at 1.20%. The market is currently consolidating within the October opening range, awaiting a decisive breakout catalyst. Volume remains moderate at 361.88K, suggesting cautious positioning ahead of key economic data releases. On October 14th, the Office for National Statistics released concerning UK labor market data. The unemployment rate rose to 4.8%, up 0.2 percentage points, while wage growth slowed to 4.7%, marking the weakest pace since 2022. The employment rate decreased to 75.1%, and payrolled employees fell by 93,000 between August 2024 and August 2025. Job vacancies also declined, falling by 9,000 to 717,000 in the 3 months to September. These figures paint a picture of a cooling labor market, though the decline in vacancies was the second smallest since mid-2022, suggesting some stabilization. This data is critical for Bank of England policy decisions moving forward. The weaker-than-expected labor market data initially put pressure on the British pound, with GBP/USD dropping to a 4-day low following the release. However, the downside was limited as the market had already priced in a dovish Bank of England stance, given persistent inflation concerns. The data suggests the UK jobs market is stabilizing after recent job losses, but the rise in unemployment and slowdown in wage growth raised concerns about the economic outlook. The mixed signals from the UK labor market, stabilization alongside rising unemployment and slowing wage growth, create uncertainty for Bank of England policy decisions and continue to weigh on sterling's medium-term outlook. The ongoing U.S. government shutdown is approaching the second longest on record with no end in sight, costing the economy an estimated $15 billion per week in lost output. The shutdown has delayed many key U.S. economic reports and could push unemployment to 4.8% if it continues. In response, Federal Reserve officials have struck a dovish tone, with Fed Chair Stephen Moran urging more rate cuts to protect the labor market. Market pricing now reflects expectations for 47 basis points of easing by year-end and 115 basis points cumulatively by the end of 2026. This dovish stance has weighed on the US dollar, providing support for GBP/USD. Renewed trade tensions between the US and China created a risk-off environment during the week. President Trump confirmed that trade tensions remain high, threatening 130% tariffs on Chinese imports, though he later called such levels not sustainable. China blamed Washington for reigniting tensions after a brief detente following September trade talks in Madrid. The escalation has rippled globally, with concerns about the impact on the world economy. This risk-off sentiment typically benefits the US dollar as a safe haven currency, putting downward pressure on GBP/USD. However, the impact was partially offset by the Federal Reserve's dovish policy stance, which limited USD strength. From a technical perspective, GBP/USD is consolidating between critical levels. Key support sits at 1.3267 to 1.3280, representing confluent uptrend support and the 78.6% retracement level. Below that, major support is found at 1.3140 to 1.3144, a significant cluster zone. On the upside, resistance begins at 1.3434 to 1.3469, the 2024 high and September high week close. The critical breakout level is 1.3544, the 61.8% retracement. A move above this would target the major resistance zone at 1.3725 to 1.3787. Both moving averages and oscillators are neutral, while a head and shoulders pattern has formed, suggesting potential for further downside if support breaks. For the next 1 to 2 weeks, we expect range-bound trading between support at 1.3267/80 and resistance at 1.3544. The bias remains neutral, awaiting a breakout catalyst from upcoming UK and US inflation data releases. In a bullish scenario, a break above 1.3469 would confirm bullish momentum, targeting 1.3544 initially and 1.3648 on extension. The bearish scenario sees a close below 1.3267, triggering a sell-off toward 1.3140 and potentially 1.3077. For range traders, the strategy is to sell near resistance at 1.3434 to 1.3544 and buy near support at 1.3267 to 1.3300, using tight stops given elevated volatility. Key events to watch include UKG DP data and Fed officials' speeches. Looking at the medium-term outlook for 1 to 3 months, monetary policy divergence between the Bank of England and Federal Reserve will be the key driver. In a bullish scenario, a breakout above 1.3749, the 75% parallel and 2022 high, would signal resumption of the broader uptrend, targeting 1.4000. This would require the BoE to maintain its hawkish stance, while the Fed cuts aggressively. The bearish scenario involves a breakdown below 1.3173, the 55-week exponential moving average, which would signal a medium-term top and target a deeper correction toward 1.2099. Currently, the BoE has just 7 basis points of easing priced by year-end, while the Fed has 47 basis points, highlighting the significant policy divergence. In conclusion, GBP/USD is showing resilience but remains caught in consolidation within the October opening range. Conflicting fundamental drivers create uncertainty, but technical levels are clearly defined for breakout trading opportunities. Headline risk is elevated with UK GDP and US inflation data ahead. For trend traders, wait for a confirmed breakout above 1.3469 or below 1.3267 before taking directional bets. Range traders should sell near 1.3434 to 1.3544 and buy near 1.3267 to 1.3300. Risk management is crucial. Use tight stops given volatility, monitor key data releases, and reduce exposure ahead of major events. The battle lines are drawn on the weekly chart. A decisive breakout will dictate the next major move. Thank you for watching FXTech's analysis.